K Limited prepares the consolidated financial statement. They purchased an equity investment of 2 lakh rupees. When? On 1st of April. Now the investment was designated at FVOCI. Okay, no problem. Can be? Yes. On 31st March 2012, the fair value of the investment is 2 lakh 40. So you must have passed one accounting entry. What? Investment to OCI income. In the tax in which they operate, the unrealized gain, because this 40,000 is an unrealized gain on the revaluation, is not taxable unless you have to sell it. But you don't have any intention to sell in the future. That's why you classified it at FVOCI. But one day or the other day you are going to sell it. So is it a temporary difference? Yes. On which are you going to get a deferred tax asset or liability? Deferred tax liability. Why? Because your book value is how much? 2.4. Tax base 2. On 40, you are going to create a deferred tax liability. One day or the other day, liability is going to come on your head. On 1st August, K Limited sold products to A Limited, wholly owned subsidiary operating within the same jurisdiction of K Limited, for 80,000. What accounting entry you passed? Huh? So you must have passed one accounting entry, A Limited account debit to sales. The moment you pass this entry, at what value? 80. Did the subsidiary pass the entry? What entry? Purchases account debit to K Limited. How much? 80. Now the cost of the goods sold is 64,000. So if you prepare a standalone P&L account, sales is 80, debit cost 64, you would have recognized profit. Followed, no? Difference would have been a profit. But 31st March, A Limited sold 40% of the goods to the third party. That means out of this 40% has been sold to third party. That means that becomes a realized profit. Because when you sell to the third party, what accounting entry you pass? So customer account debit to sales. How much? 32. Now you have got one more entry here, Cox account debit to bank. How much? 64. You incurred a cost of goods by paying something and you sold to A and made a profit of 64. Now what happened? The consolidation happens. You are going to consolidate everything. In consolidation, the intercompany balances are going to get eliminated. Intercompany purchase and sales are going to get eliminated. Okay, then what happened? No, you recognize the closing stock. You will pass the who is going to pass closing stock? K or subsidiary? Subsidiary. What is the closing stock entry? Cox account debit to closing stock account debit. This will go to the balance sheet to Cox. At what value, students? 48. Because out of 80 what you received, 32 you sold. 48 remained with you. Now sales purchase will get cancelled. And irrespective of whether you are sold to third party, whether you are not sold to the third party, when you prepare a consolidated balance sheet, your intercompany eliminations are going to happen. So if I prepare a P&L account, on the debit side of the P&L what comes? Cox comes. How much? 64. Sales comes. How much? 32. And you have got closing stock 48. How much it comes to? 32 plus 48, 80. Oh, then you say I made a P&L? No, you say from this closing stock less URP, unrealized profit. How much? How much is unrealized profit sitting in 48? So what is you have to find out the percentage now? What is your unrealized profit sitting? 12. Unrealized profit is how much? Okay, so 64 worth you sold for 80 minus 80 minus 64 divided by 64. 25% is your profit on cost. Followed, no? See, 64 rupees worth of thing you sold for 80, no? How much is the profit on cost? 25%. On sales, 20%. Somewhere small kids will learn, no? Okay. So now, what is the 20% on your closing stock? Is sales value at 48. So 48 into 0.2, 9.6 is the profit element, correct? Let me check. 9.6 is the profit. Okay, it is an unrealized profit. So what you would have done? Minus 9.6 you would have taken from this 48, and you would have said minus 48, 38.4. You would have shown this. So in your consolidated balance sheet, the stock is shown at 38.4. Agreed? What income tax is? Now they say 48. They say, look sir, your consolidation is separate. But in my records, when the truck came, it came with one invoice, and invoice is showing 48. So the difference between these two, this is my tax base, this is my book value. Do I have got a deferred tax asset or liability? I have got a deferred tax asset on this intercompany stock transfer, which is unsold at the end of the year. Are you clear about this adjustment? Okay. See now, you have understood this P&L statement what I prepared. Okay, first of all, have you understood 25%, 20% profit say? So my 20%, my unrealized profit is 9.6. So I cannot show in my consolidated P&L 48 closing stock. What I'm supposed to do when you pass this for accounting entry, no? When I consolidate, I have to deduct the unrealized profit. You will get the whole mastery over this when we discuss about consolidation chapter. You understand, exactly understand. Because of this unrealized profit elimination, you show closing stock of only 38.6. This is your book value in CFS. But where physically the stock is lying? Subsidiary. Now subsidiary is assessing officer. He will look standalone statement, no? And as per subsidiary, what is the tax base? 48. So on the difference between, this is my tax base now, this is my book value. On these two differences, I am going to get deferred tax asset because my carrying asset is lower than the tax base. That's it. Nice question, no? Now they received 2 lakh rupees from a customer. Okay, chalo, one more thing. You pass one entry, bank account debit to customer. Advance. This payment is in respect of services to be provided from 1st November to 31st July. Now when did you receive? 31st October. Now Ind AS 115 says that, look, if you have not fulfilled the performance obligation, that means you have not delivered your promise, you cannot recognize it as a revenue. So you have to treat it like a contract liability. Big word, customer advance. Now X recognized revenue of 1,20,000 up to 31st March. So you debited contract liability, credited revenue, and will recognize remaining in the next year. So at the end of the year, is there anything in your balance sheet? Yes. How much? 80,000 contract liability sitting. Yes, Vidya, clear? Now, under the tax jurisdiction, they say that, look, Baba, I don't understand your 115 story and all. You received 2 lakh rupees now, pay tax on that. Next year, you may show P&L. I'm not concerned. I'm not going to tax you that. So on this 80,000, which is sitting in the balance sheet on which is not my revenue, I end up paying like an advance tax. Followed, no? So this contract liability, book value is how much? 80. Tax base? 0. So do I have got an asset DTL or DTA? DTA, because this is a liability, carrying amount is more than it. But imagine, no, you didn't earn the revenue, on that you paid the tax. Definitely you are going to get a refund now in the coming year, but not required. That analysis is not required in the exam. Exam, you go with these equations. Explain and show the tax consequences of, here the catch here is in this question, current and deferred, both you have to speak. So how much is the current tax because of the sale? You sold something. So sale is having a current tax effect. Of the three transactions will be reported if you're assuming 25%. Okay, we'll solve this question. Deferred tax on equity investment. The unrealized gain is not taxable unless sold, correct? They only told, no, unless you sell your FVOCI, whatever uplift you do, fair valuation uplift you do, I am not considered. Therefore, no current tax impact. Are you going to pay tax on that 40,000 rupees? No. So current tax impact is not there. So this is one addition in this question. Huh? None of the previous question we spoke about the current tax impact. However, will it create a temporary difference? It creates which temporary difference? Taxable or deductible? Taxable. Temporary difference on which DTL to be recognized. See, you explain it. You explain that, look, when the fair valuation of that equity investment was increased to 2,40,000, there is no current tax impact because definitely in the income tax computation statement they must have deducted this because it is unrealized. But this is a temporary difference. Why? Because the day you sell, you have to pay tax on it. So deferred tax is going to come. So what is the book value? So calculation of deferred tax. So write the story here like this. Calculation of deferred tax. What is your book value? 2,40,000. What is your tax base? 2 lakhs. Yeah, students, again, I repeat, please go through online students also. You may have doubt here and there. Just think about it. That's very important. You have to spend time with yourself to learn. Go through my chart, see why I have told, what I have done. Then you understand, because the moment you crack this tax base, then problem is solved. Everything is a child's play there, no? Rest everything. Tax base is the heart of this problem. What is the difference? 40,000. This is which? Taxable temporary difference. Therefore, deferred tax liability at the rate of 25% is equal to 10,000. Is this a current or non-current? Okay, before that, where you are going to show it? P&L is an expense, no? This is an expense. Will you show in the P&L or OCI? If I ask you, plus an accounting entry, what accounting entry would have suggested me? Tax expense account. See, for that everything is the same entry, no? Tax expense to liability. Expense, what you will do? OCI. Why? Because the original investment on which you have classified, you have classified at FVOCI. Followed, no? Since equity investment is classified as FVOCI, DT expense is reported in OCI. This will go to OCI now. It will not come to P&L. So profit before tax less tax expense when you show, no? In that, this item will not go and sit. Why? Because this is not coming because of any P&L items. It is coming because of the OCI item. Okay. The second leg is what? Deferred tax liability. Is it a current or non-current? Why? Because the equity investments you have not planned to sell. When this is going to get reversed? It will get reversed. I don't know when. 10 years down the line maybe. So, deferred tax liability is classified as non-current. Perfect, no? Everything you explained. Go back to your explanation, what you explained, and read it. You see one flow there. You explain, look, this is the current tax effect, this is the deferred tax effect, this is the amount of the deferred tax. This leg of expense will go to OCI because of the classification is so and so and so. And this leg of liability will be classified as a non-current because I don't have any intention to sell it. Perfect. Now what else we require? This is explanation. You explain everything in detail in a very systematic manner. And that explanation may include calculations. Are you clear? Yes. Next, unsold inventory. Deferred tax on unsold inventory. Now we are talking from the consolidation perspective. Keep in mind, when K Limited sold to A Limited, parent generated profit how much? In their standalone P&L, how much is the profit? 16,000. On this, should they not pay current tax? This result into current tax of rupees 4,000. 16,000 into 25%. 16,000 into 25%. How they are going to account it? See, you didn't write this previously because for the first case, current tax effect was not there, only deferred tax was there. But for this intergroup transfer, you have got a current tax expense also. What you are going to do? Debit to? Okay, that current tax expense where you are going to show? P&L or OCI? This is debited, or not debited, this is reported. This expense is reported in P&L. And how do you categorize this liability? Is classified as current. Because you have to settle it, no? Next, within 6 months or so, you have to settle it. That's it, done. So we told a story that, look, this is my current tax expense. I will show it as a current tax liability. You could have told further also. What is that one more leg? Your, what is that? Subsidiary also sold to third party, no? On that, current tax is not going to come. Why you are not speaking about it? You should have asked me. I was expecting this. Why subsidiary when they sold? On that also current tax will come. Why you don't speak? Because at what value they sold to third party, have they told you? And then how do you calculate current tax? They should have given that. No. Anyhow, their expectation is not that. They want to look into the tax impact of this between a parent and a subsidiary transaction, not a subsidiary and a third party. That is, they are not interested. Now, however, in CFS, this is where in SFS tax liability came. Same liability will move to CFS also. Deferred tax will come due to unsold inventory. Why? Because you are loaded with the profit. In the CFS, deferred tax impact is going to come. You have loaded them with the profit, no? Done? Yes, now we have to calculate. What is the calculation of deferred tax? What is the book value of inventory? Or book value? Simply say book value. What is the book value? 38,400. How did you get this? 64,000 into 60%. This is the book value of the inventory. Minus, what is your tax base? 80,000 into 60%. 48,000. Clear now? Everyone is clear, right? So this is 9,600 is the temporary difference due to URP. Which difference it is, taxable or deductible? Deductible temporary difference. because my inventory's carrying amount is lower than the book value. Therefore, DTA at the rate of 25% comes to 2,400. Now, where do you take this? What entry you will pass? Deferred tax asset account debit to deferred tax income. Where do you take that deferred tax income? Huh? P&L or OCI? P&L, no. Because this inventory value, where will show? Will OCI or in P&L? P&L, no. Then deferred tax also should come there only. And this asset, okay, it's a current asset because anyhow it is going to get sold next year. So, which one? Where? Deferred tax is on the moment you sell this to third party, unrealized profit gone. No, next year inventory will not be there. And when you think this inventory will be sold? If they think that this inventory is going to be sold after 3 years, that means next 3 years in your balance sheet, inventory will be lying at 38,400 in the consolidated, 48,000 in their standalone. That means that this deferred tax becomes one non-current asset. Perfect? Yes. The deferred tax asset can be recognized as there are taxable profits, future taxable profits. Okay, so they didn't speak about the classification and where it will go and all. If you want, you can write here. In the suggested answer or in the study material, they didn't say that this is a current asset like that. If you want, you can always write it. But they said, look, since the deferred tax question came, they said, can you recognize this? Yes. Why taxable profit? Have they told in the question? Read, no? Second question. Have they told you in the future taxable profit will be there? They are not told. Okay, maybe you can take it as an assumption. Yes, next one is the customer advance. Receipt of advance. How much? Rupees 2 lakh. Does it has got any current tax effect? Yeah. Okay. Now think, what entry you passed? Bank account debit to customer advance. You prepared one income tax computation statement. Profit as per P&L account. Is this customer advance sitting there? No, because you took it to the balance sheet. Then will you add income as per income tax? Will you add this 2 lakh rupees? They said no, you have to pay tax right now. That means you have got a current tax liability. You can't say, sir, this 2 lakh out of this 80,000 I have rendered the service and all. So, has current tax effect liability of rupees 50,000, irrespective of whether you have given service or not. On this 25% you have to pay the tax. This is what your income tax act is saying. Clear, Kriti? Perfect, no? However, due to revenue recognition principle of 115, Ind AS 115, we have deferred tax. There is a temporary difference now, because Ind AS 115 do not permit you to recognize revenue. Income tax is telling recognize revenue right now on cash basis. Ind AS 115 is telling, okay, recognize only 1,20,000 out of this, 80 you don't recognize because you didn't render the service. Clash came. Deferred tax is going to come. Are you clear? Okay, now I need to calculate a deferred tax. Right heading, calculation of deferred tax. What is my book value? 2 lakh minus 1,20,000, 80,000. Minus tax base Yes, Vishnupriya. Tax base. Tax base is 0. Why? Because income tax didn't recognize, nothing they recognized in the balance sheet, everything they recognized in the P&L only. So you have got a difference of 80. This is which? Taxable or deductible? Am I talking about the book value of asset or liability? Contract liability, no. Liabilities book value is more than the tax base. So deductible temporary difference. It is not a permanent difference. Otherwise I would have made this same. So deferred tax asset at the rate of 25% comes to 20,000. Can be recognized due to future profits. Perfect. Now I love this question. Very beautiful question, at least among all the questions. It's a very nice question. You talk about the current tax effect, you talk about the deferred tax effect, you calculate, you explain why deferred tax are going to come. If it's going to happen, how do you classify and present it? If liability is there, how do you show it? Followed, no? And if you see current tax liability, they showed only one time. Huh? Every time they didn't repeat. Oh, current tax liability is an expense and it will go to thing. P&L or OCI, only OCI they spoke. P&L they didn't speak. Understood? Followed, no? Yes. So we'll move on to the new question which is added in the new study material of your thing. In fact, I could have done this on the day one, first question. But anyhow, now since you have got a fantastic understanding, they have split one question into 3 questions. Let us read this. Okay, I want you to solve it in fact. H Limited is a manufacturing company, wants to calculate the taxable profit and loss, means tax profit for the year ended 2018. The statement of P&L account and OCI and the balance sheet and notes to accounts they have given you. So you have to calculate the taxable profit. Tax rate is 17-18 financial year. We are into 17-18 is 30%, but the new tax rate is 32% for the year 18-19 and beyond, and already enacted before the end of the year. So for us, 32% is applicable. Calculate the taxable profit for the year ended 37 and current taxation. So we are going to speak only about current tax, nothing related to deferred tax. So you should be able to solve this. Current tax, no. From your intermediate, articleship, you are doing taxes only. Anyhow, we'll do it together, no worry. So you have got the PP, product development cost. You see the item of PP is an item of deferred tax. Product development cost is the item of deferred tax. Investment in subsidiary. Oh, this is what? A standalone financial statement. How do you know? Because if it was a consolidated financial statement, you would not have shown an item called investment in subsidiary. Now, is it at cost or fair value? We don't know, because we have got an option as per Ind AS 27 to show it at cost or fair value. Trading investments, trade receivable, inventory, cash. Chalo. We'll come to the equity part. Share capital is given, accumulated profit, which is nothing but retained earnings. So you have sitting one revaluation surplus. Then you understand that these items must have been revalued in day 16 on deferred tax subject matter. Deferred income on government grants. Oh, that means there is one government grant received, which is sitting in the balance sheet. That means this must be a capital receipt, not charged to revenue. Liability for the product warranty. You are making one provision for warranty cost. Deferred tax liability from 16-17. That means you are opening deferred tax liability cumulatively for all things they have given you. Trade payable, medical benefits for employees. What is this medical benefits? PVDBO. Followed, no? So something like benefit expenses they are planning. Now P&L, revenue, cost, operating cost, finance cost, profit before tax. So this is what you start with, correct? profit as per P&L account. Now the depreciation expenses for the year 17-18, where it is there? It must be sitting in COGS. Is as per income tax rule is 72,10,000. Depreciation allowed for the purpose of the financial reporting, oh, it is included not in COGS, but it is included in the operating expenses, 59,50,000. So what you will do? Add 5950 minus 7210. Fine. This is only will for the taxable thing. Cost of the FP is 5.6 crores. Now we need a tax base. No, for this we need this. From this, if you deduct 72.1, you get the tax base. And H Limited deducted expenses of 1.6, 1 crore 45 lakhs in prior to financial year 17-18. So if you are looking for a tax base, what is my tax base? What is my tax base? 5.6 minus 1.45, because you deducted some expenses. No, God knows what expenses it is. From the cost, you have deducted some expenses, some sort of expenses, plus 72.1 is going to give you the tax base. Further, as on 31st March 2018, H Limited for the first time revalued its property, plant and equipment to the market value of 4.2 crores. And you made a revaluation gain. Now you get connected. So if you go back, 30.8 is the revaluation surplus, 42 is the fair value. Have they recognized this revaluation surplus? No. On this revaluation surplus, OCI is going to come. Where it will go? Deferred tax, OCI. Now in 2014-15, H Limited incurred a product development cost of 35 lakhs. These costs were recognized as an asset and amortized over a period of 10 years. So 14-15, today which we are into 17-18. For tax purpose, H Limited deducted the full development cost in that year only. So what is the tax base? 0. What is my book value? Today, at the end of 31st March 2018. Huh? 20? How did you get? 35, 10. Okay. Into how many? 14, 15, 16, 16, 17, 17, 18. 3 years, no, Baba. We are into 2017, 18. You incurred 14, 15. Okay. So they have not told you. Say if I say 15, 16, 1 year, 16, 17, 17, 18, after 3 year depreciation, how much it comes to? 1 minute, 35 lakhs divided by 10, 3 lakh 50 into 4 year if I take 14 lakhs minus 35 lakhs, 21. If I go back to the balance sheet, you see that the product development cost is 21 lakhs. Then you understand that these expenses from 1st April 2014 you started. That means 4 year depreciation you have charged. You understand? 35 lakhs is the cost. So 14, 15, 15, 16, 16, 17, 17, 18. 4 year depreciation you have charged, which they have allowed full. Understood? This story is clear. Now trading investments were acquired in the preceding year at a cost of 80,50,000 rupees. These investments are classified at FVTPL and recognize their fair value. Fair value adjustments are not allowed. So what is the fair value today? 80,50,000 is there, no? Its trading investment fair value is how much? 72,80,000. So there was a fair value reduction. What did you do? You must have charged to P&L account. Did they permit? No. Again, deferred tax is going to come there. That means you have to add back, no? Expense your claim, no. Now the bad debt provision amounting to 45 lakhs, 45 lakh 50, relate to two debtors. They have given you the breakup. 45 lakh 40 includes 28 lakhs and 17 lakh 50. Now, receivable has originated in the year 1516 and 100% provision was recognized in the preceding year. That means it is the bad debt only, full within 1 year only you recognized, no, in the last year, preceding year you recognized it. And the debtor of 17,50,000, which was in the year 1617 you incurred, 100% provision was recognized in the year 1718. Now the tax laws gives one different weird type of deduction here. Whatever you provided 45 lakhs, they are going to add it back straightforward. Followed, no? They say that the tax laws allow 20% provision for overdue more than 1 year, 30% for overdue more than 2 years, and 50% for overdue more than 3 years. They are given one slab. So what gets added back is the bad debt provision, what is made as per the books, and what gets deducted is as per the slab here. Now you get a flavor of DT, right? DT is something like this only. Now H created a provision for inventory obsolescence with the Ind AS 2 requirement. New provision is created in this year only, 3,78,000, and total provision is 6,30,000. That means opening provision was there, you added more. Being a general provision, this is not tax deductible. Add back is going to happen. It's not going. They are going to permit this expenditure. Okay, so this has happened in the current year. Last year they came 16, 17, 18 you written off full 17,50,000. Now government grants are not taxable only. When you receive it, whenever you expense it, so this is a permanent difference. In 2017, H increased the liability for the product cost by 1,75,000. Product warranty costs are not tax deductible unless it pay. So this is a deferred tax item. You are going to whatever warranty claims you claim, you add back. During the year, H introduced healthcare benefits for the employees. They are allowed as a tax purpose only when they are paid in less per of Ind AS 19. We understand now Ind AS expense, employee benefit expense to PBDBO. But they say that when you leave the service, then only will provide the benefits. Deferred tax item. That's why I'm doing this question at the end. Okay, like this adjustment covers almost all the things for you. Don't worry, in exam you may get a smaller version of this. Penalties for the violation of law included in operating expenses 63. What you will do? Add back. Deferred tax? No. Permanent adjustment. So we have came across permanent difference here, permanent difference here. Only 2 items till now. Rest everything is a temporary difference. Tax laws allow deduct expenses for petrol only up to 1,40,000 per vehicle per year. You have got 4 vehicles and the total petrol expenses amounting to 7,21,000. We have to check now what you are permitting, what I have claimed. Note, this illustration is prepared for a purpose of understanding of the tax and no way it is connected with the income tax. That means they say that, look Baba, we are a different discipline. Don't try to apply your mind and say, sir, what is this? Our income tax is selling so much. That is different discipline. Only in multidisciplinary we will see that, not right now. Okay, so what we are supposed to do? Current tax calculation, no impact. This item will go to the balance sheet. Yes, first thing is product development cost. We'll solve this. How much is my annual depreciation? $35 lakhs divided by 10, 3,50,000. Now tell me students, see, forget about working. What I am supposed to do? First of all, tell me. Forget what I am doing here. Forget this. What I am supposed to do? What they are asking me, what to do? Calculate the profit. For this, what I am supposed to do? I should have started with the profit as per P&L. No, what I am doing? Because certain things there need certain workings. So now if you go through this, all the items, so we have to calculate the taxable profit as per P&L, add back, deduct, all those things. To do that, in this entire question, do you see, do you need to do any workings for something? Okay, one is I only told you development cost. Besides that, do you need any workings? Or straightforward amounts are available to you? Huh? Sorry? Petrol. Yes, very good. Petrol. Then bad debts, very good. So why I want you to tell me, see, I would have put that like this. But I want you to think and tell me, yeah, what you said is perfect, 100% correct. Next working note is for the petrol cost. There is some disallowance, no? So I need to do one working note. So how much is my actual? How much is my actual cost? 7,21,000. How much is permitted? How much? Okay, yeah, others. How much is permitted? 1,40,000 per vehicle. How much vehicle? 4, 5.6. So add back is 1,61,000. Or separately also you could have done. Even I don't give much importance to this working also, because something you would have added back, you would have deducted there later. Or you can give the net effect of 1,61,000. Correct? Next one is my bad debt provision, which is your favorite. So how many bad debts are there? Only 2 bad debts. So I have got a debtor A. Now, how much I claimed? Yeah, sorry, how much I claimed this year? No. You read the question. Yes, students. So if I take back you to the question, I'll just take you back you to the question. You read here. They said, look, bad debt provision till date is how much? 45,40,000. There are 2 break, 28 lakhs, 17 lakh. Now debtor A came when? 28 lakhs. In the year 15-16, and 100% was provision in the preceding year. That means by 16-17, 100% is claimed. That means this year we didn't make any provision relating to A. But the debtor B, 17,50,000 originated only last year, and 100% was done in this year. So this year provision add back will be 1750. But how much you can claim income tax purpose? Debtor A in the year 17-15, 15-16, today's day, he is due for how many years? 2 years. So overdue for more than 2 years, you can claim 28 lakhs into 30%. Okay, let us see that. They said that tax allows 20% deduction overdue for more than 1 year, another 30% for overdue more than 2 years, and 50%. Now, today we are into 2017-18. Now, when you originated 15-16, correct? Now, today's day, by end of 31st March 2018, how much you are overdue? 16-17, 17-18. Sorry, 15-16, 16-17, 17-18. So you are more than 2 years. So if you are overdue for more than 2 years, then 30% on 28 lakhs will be permitted to. 17-18, you originated in 16-17. So 16-17 1 year, 17-18 2 years. So you are more than 1 year, less than 2 years. How much is permitted? 20% of 17,50,000 is permitted. Are you clear? Yes. Okay. Yes. So next is the debtors provision. So for debtor A, which is overdue greater than 2 years, 28 lakhs into 30% we will calculate, which is 8,40,000. And B is overdue greater than 1 year, 17,50,000 into 20%. You are clear now why we are taking this? Because they originated in the 15-16. Now we are not clear whether at the beginning of the year or at the end of the year. So in the year 15-16 means we will make an assumption, even though they have originated on the last day, we will provide you one full deduction. So 15, 16, 16, 17, 17, 18, they have completed 3 years, which is more than 3 years, 2 years, but less than 3 years. So not 50%. For debtors, it is 16, 17, 17, 18. More than 1 year, but less than 2 years. Okay, done. So we will do the calculation of current tax expense. Write the heading, calculation of current tax. Profit as per P and L. How much? 59 lakhs, 50,000. Yes, now tell me students one by one expenses which I need to add back. Yes, students. So please pause the video and do the calculation. We know that there are some adjustments one by one. We discussed almost. So what all add back items are there, you please add back, and what all deductions are there, please deduct and get the total taxable profit. We'll compare the answers. Yes, students. So we'll check the answers. See, my profit as per P&L account, so we know. Now first is, I will go to that 9 adjustments. How much is depreciation as per P&L? 59.8. I will add it back. Correct? No confusion there. Amortization, 1 year only, not the cumulative 4 years. That we just do to check the numbers. Revaluation of the investment, 7,70,000, we are going to add back because we are not going to tax it. Bad debt provision, 17,50,000 is the current year only. Other things are all last 2 years back, 3 years back they have done. Inventory obsolescence, 3,78,000 we are going to add because income tax is not going to give any deduction for this. Product warranty cost for the year is 1,75,000. What they have paid is going to get the deduction. Healthcare benefits during the year only they introduced. That means the whatever amount of sitting in the balance sheet, entire amount is disallowed because this is this year provision. Fines and penalties 63,000 disallowed, and petrol over limit is 1,61,000. Did you get 1 crore 20 lakhs 47,000? Did you miss any item here? Any mistakes? Which one? No, I won't like to discuss the mistakes. Petrol expense, okay, we have done that calculation, working note number 3. In fact, you only told, no? We need one working note for the petrol. 1,61,000? Are you allowed 1,61,000? No, that's what I told you in the working. We could have avoided that. We could have added 7,21,000, allowed 1,60,000. Yes, any mistakes? What? Where? Petrol only. Yeah, so you have to mark this, your mistakes. Then, what happened? 24 lakhs 50, be careful. Fine, others, done, no? Yes, now we deduct 3 expenses, 72 lakh 10 depreciation during the year, bad debt provision, and your product cost. So you get the total taxable profit will be 93 lakhs 80,000 into 30%, you get 28 lakh 49. Easy question, simple question. And with this we calculated the current tax. See, the probable, highly probable question. No, they have split this question into A, B, C. This is 12A, 1A, question 1A. So that's what. If you open the study material, the first question you are going to come across this. Since we discussed all the components, that's what I am asking you to do it. Done? Yes, so we will move on to the journal entry. Current income tax expense account debit to current tax liabilities. That's it. Yes, so first question is very simple question, only on the current tax. Now they said, look, based on the balance sheet and the notes of the previous example only, you calculated the tax expense. Now you need to calculate the tax base of the assets and liabilities on 31st March 2018. So you have to just tell, for this, what is the tax base? What is the tax base? Tax base. You have to just tell the tax base. Balance sheet adjusted. Okay, now that balance sheet and this balance sheet, what is the difference? Everything is same except you passed one entry, no? What is that entry? This entry. So because of this entry, you have liabilities and your retained earnings have come down. This accumulated profits have come down. One new item called the current tax liability came in the balance sheet. Remaining every information is same. So what do you need to do? Go one by one asset in the balance sheet and prepare one statement. Say first example, to tell you, for example, first is the PPE. You have to give me what is the book value, what is the tax base. Easy. Okay, for this, no, one thing I will do, we will do one working note, tax base of the PP. Certain things we will do it, two things I will do it. Tax base of PP. Working note number 1. What did they say? Tax note for the PP. So, the working note, this is the, to read it back. See, what is your cost? Right, cost 5 crore 60 lakhs, correct? Less, how much is your previous year deductions for depreciation? Cumulatively, from the time you purchase this till now, how much deduction you claim? 1 crore 45 lakh 60,000. Sorry? Random expenses, okay. When did you purchase this PP? Have you not charged any tax? 17.72 lakh 10,000 is current year, no. So I will assume that this must be the accumulated depreciation. Less current year depreciation, how much? 72 lakh 10. If they would have told me 72 lakh 10 is the cumulative value of depreciation, then I would have assumed that 1 crore 45 lakhs is the random expense. Since I don't know what it is, I will assume that it must be your your depreciation. Now tell me, what about this revaluation? No. Why? Because it is not tax deductible. So my tax base comes to 32 lakhs, 3 crore 42 lakhs 30,000. Are you clear? Yes, next we will go to the working note 2, trade receivables. So they have given one equation for the trade receivables. They said that the bad debt provision till date you have made accounting, forget it, accounting. Their logic is, look, this is what they allow. They are given a slab, more than 1 year, less than 1 year, this. They don't consider this. But you know that you have got 2 debtors on which you have to make a provision. These are the only 2 people who are due for more than 1 year. So first you write book value of the debtors. What is your book value of the debtors? Two crore 19 lakhs 10,000. Look at the balance sheet. Total debtors is how much? 2 crore 10 lakhs 19 lakh. Add RBD as per books. How much is as per books? Sorry, 45 lakhs 50,000. Out of this, 17 lakh 50 is this year made for the last year, one new customer, and balance is that debtor A which was done 2 years back. This year, because 100% you have evaluated, taken. Less, how much is RBD as per tax? Now let us go to A, debtor A, rupees 28 lakhs. So, in the first year, when he was due more than 1 year old, this you incurred in the year 15-16, no? In the year 16-17, since he was 1 year more, have you made a provision for him? Yes, how much? 20% of 28 lakhs. He was 28 lakh rupees is the total debtors. When you incurred 15-16. Have you made any provision? Because at that time, in the 15-16, did you made any provision? In the 15-16, did you made any provision? No. Why? Because it was due within 1 year. But the moment he becomes due more than 1 year, you made a provision first time in the year 2016, correct? How much? 5,60,000. That you claim. Okay. In the 17-18, did he pay? No. So he is more than 2 year old now. So you provide 30% in the 2017-18, which is 8,40,000. Are you clear about this working? So total 14 lakh on account of debtor A you are going to claim. See, he incurred 2015-16. As per accounting logic, you gave some full 100% you have written. He is not going to come back. You add that. As per tax says that, look, if you incurred a debt this year, I will not allow any provision. But Baba, he is not due only. This year only you do. But if you due more than 1 year, you have to claim 20%. So in the year first 16-17, I must have claimed 1 year 20%. Then I am into 17-18. So I would have claimed 50%. I have never claimed. Now I'll go to debtor B, who is how much? 17,50,000. He came into picture only in the year 16-17. In the 16-17, did I claim? Did I claim any money? No. So he is more than 1 year when 2017-18. There I claimed 20%. So on this, in accounting I have written a full, but income tax has given me two deduction of 14 lakhs and 3,50,000. So the tax base of the debtor is 22 crore 47 lakhs 10,000. Are you clear about this working? This is the most tricky thing in this entire problem. For this, because problem comes with that assessment year, irritating year. No? They should have gone for full year only. Very nice. 2017 means we understand 17-18. So this person came in 2015-16. First year he was due, we claim the deduction. Second year he was due more than 2 years, we claim 30%. This person came in the year 16-17 only. So only 17-18 we claim 20%. So this is the total RBD we claimed for two debtors, and whatever we claimed in the accounting we added it back. Are you clear? Okay. Yes. Now please pause the video and say calculation or determination of tax base. So what I want you to do is you write here. Okay, any of this you can do it in the next step. Okay, just tell the tax base. No need to have two columns. There's tax base, no deduct carrying amount. Carrying amount you want in the next step when you have to calculate the deferred tax. Just tell me the tax base now. Or you can club also. What you can do, you will do it like instead of can we club this question with the next question? Because in the next question they asked you tell me the deferred tax. For this classification is important. So you do one thing. You can have one column. We will do it in the last one. DTA by DTL. This is difference, deductible taxable difference, temporary difference, tax base, book value. You have to start with one item, PP. What is your book value? 4 crore 20 lakhs. What is your tax base? We already calculated, correct? 3 crore 42 lakhs 30,000. Is there a temporary difference? Yes, 77 lakhs 77,000. Is it deductible or taxable? Taxable. So you have got a deferred tax liability to 24 lakhs 86,400. Followed, no? In bracket, it's a liability. Like this, you fill the entire table. Followed, no? You have to put the book value, very easy, it's already there. You already calculated in the previous step. Or it's already there in the balance sheet. No need to calculate. Tax base for 2 we calculated. Others you think temporary difference is a difference. Deductible or taxable, and then accordingly deferred tax. Yes, students, please pause the video and do it. Yes, students. So we have done the first one. What is my next one? Product development cost. See, what is your carrying amount? 21 lakhs. Tax base 0. Why? Because income tax you already claimed the deduction. So you have got 21 lakhs. Taxable or deductible? Taxable. On this 6 lakhs 72,000. Investment in subsidiary 1.54. 1.54. Same, no, there is no deductions. Tax also recognized. Has it happened that they have made a profit, you have taken a share of profit, income tax says that I will not pay on this thing, you will pay on the tax dividend only? Nothing. So no. The next one is investment. 72 lakhs 80,000. 80 lakhs 50,000. 80 lakh 50, no? Are you clear? Why? Because they say that, look, your FETPL and all, we don't understand it. So you have got a difference of 7.7. What is this? This is deductible. 2.46 is the deferred tax asset. Okay. Okay, so I'll move on to the next one. See, my tax base here, we have already done for PPE. We have already calculated. Acquisition cost of 8050 will be there. Trade receivable, we have got the working note, inventory, cash. Okay, anyhow, I'll move on to the next one. And okay, next is they have asked you to calculate the deferred tax, which we clubbed it together. So, are you clear about this? 1, 2, 3, 4 items. Yes, next is my trade receivable. What is my book balance? 2 crore 19 lakh 10,000. What is my tax base? 2 crore 47 lakhs 10,000, which we calculated due to working note. How much is the difference? 28 lakhs. Taxable or deductible? Deductible. Why? Less than, tax base is less than the book value. So we have got 8 lakh 96,000. Inventory is how much? As per book, 1 crore 6 lakh 40,000. As per tax, more or less? As per tax, you have got a more inventory or less inventory? More. How much? How much you added back there? 6 lakh 30, no? Inventory obsolescence, they say that, Baba, we don't know. Cumulatively 6.3. This year you added something, but I am talking cumulatively, no? So 6 lakh 30, that means 1 crore 12 lakh 70,000. 6.30 is the temporary difference. This is also a deductible difference. 2 lakh 1,600 is the tax. Clear? Cash and cash equivalent, CCE 63, 63, no differences. Deferred income 14, 14, permanent difference. Yes, so next is, okay, now we have done liability for the warranty. How much is liability for warranty? Liability for product warranty 5.6, 5 lakh 60,000. Do you have this liability for warranty there in income tax? Huh? That is you paid, but do you have a liability in the balance sheet? No, the year you pay, you claim the expense. No. But when you pass this entry, 5 lakh 60,000 expense to liability, they simply reverse it. They say, I don't recognize it. So you don't have any tax base for this. And the year you pay, you claim the deduction. But that is not going to hit your liability. No. So you have got 5 lakh 60, deductible or taxable? Now the rules will change, deductible. Why? Liability carrying amount greater than the tax base. So you have got 1.79. Trade payable 2.67, 2.67, no adjustments, no deferred tax. Is there some? Yeah. Medical benefits. So you have got 24.5. What is the tax base? 0. So we have got the medical benefits 24.5 and 0. Yes, so we have got all the deductible expenses here. Taxable. So this is DTA, this is DTL. Net deferred tax will be 8,51,200. That's it. Yes, students. So with this we are done with this standard. Thank you.